Welcome everyone to the Microstructure Exchange. Good to see you all. My name is Björn Hagströmer, and I'm the moderator today for the webinar that will be held by Greg Eaton. And we have a couple of announcements before we begin. The first one is that we have added an announcement to our website about a nice conference coming up related to microstructure. It's the 8th annual conference on financial market regulation at the SEC, and they have a nice program, and you can find the link to that on our website. And the second one is really exciting to us at the Microstructure Exchange, because since we had the last one 2 weeks ago, we have passed the 1 year mark for the Microstructure Exchange. So we have had about 30 seminars like this one since we started in April last year, and it's been great fun for us to do this, and we look forward to keep it up as long as you're interested. And we would like to thank everyone who has contributed by being here as a speaker or acting as a reviewer for our paper selection, and of course everyone who's coming here, attending and listening to the webinars. So thanks a lot for that. Now the format for today is that Greg will have roughly 45 minutes, and he has decided that he wants the questions as we go. So whenever you have a question, you can unmute your microphone and interrupt if you want to. You can also type it in the chat, and then I can ask the question to Greg. So I think those are all the announcements. We have a very topical paper today about the Robinhood traders, the high frequency traders, and so on. So I'll give the screen to Greg.
Thanks, Bjorn, and Andre and Cameron and Andreas and Kate at the Microstructure Exchange for inviting me. I've been excited to present ever since I got the email invite. So as Bjorn mentioned, I'm going to talk to you today about zero commission individual investors, topic of the paper, high frequency trading and stock market quality. This is co-authored with Clifton Green and Yanbin Wu at Emory, and my colleague at Oklahoma State, Brian Roseman. Clifton unfortunately has to teach right now, so he's not going to be here, I don't think, but Brian and Yanbin should be here. So depending on the type of question, they might be able to answer it in the chat as well. So, okay, let's go. All right, so as you probably all know, in this room, retail trading has exploded over the last year and a half. Recent estimates put the retail value market share as 20% or more of stock volume in the US anyway, and that's more than double where we were at a couple of years ago. One important innovation in driving this explosion are the introduction of zero commission trades, and Robinhood was a early player, an innovator in that regard. And in addition to that, Robinhood has done some other things that encourage participation, such as no account minimums and super user-friendly interfaces. And as a result, the quintessential poster child of the zero commission platform, Robinhood, is last we checked at 13 million users. That was as of a few months ago, so probably even more now. But even that number puts them at par or even significantly greater than some of the other major US brokers. And in addition to that, there's some estimates that suggest that Robinhood trading volume makes up as much as 1/3 of the trading volume for the major US retail brokers. So Robinhood is a really important player in financial markets, but we're just now starting to see research coming out about them and the importance and how it affects financial markets. So that's where our paper comes in. we studied the effects of zero commission traders, and specifically traders like at Robinhood, and their effect on financial markets. More specifically, we start out by examining whether or not they appear to be noise traders, and then turning to the chunk of our paper, we spend time focusing on the effect of the zero commission or Robinhood traders on market quality. So let me spend a couple slides sort of just describing the high level findings, and then I'll get into some more details after that. So we start off with examining whether or not the Robinhood investors appear to be noise traders or informed traders. This narrative, of course, in the media is that they appear to be noise traders, but we wanted to take that to the data to have a little better understanding. So we first document some interesting descriptive statistics. So the Robinhood users tend to be quite young and inexperienced on average. For example, 78% are under the age of 35, half are first-time users. And they don't appear to be particularly sophisticated based on some of these descriptive statistics. So for example, we go to the web traffic on their FAQ page, and the FAQ with the most website volume is, what is the stock market? So not necessarily a good sign in terms of super sophisticated, but we do a little bit more formal analysis by examining whether or not their trades are predictive of future returns. So that the trade direction proxy we use are ownership changes on the Robinhood platform, and we find that those ownership changes are unrelated to future returns, which is consistent with noise trading. And one interesting thing in terms of fitness into the literature, there's been some somewhat surprising evidence in the last 5 or 10 years or so that finds that retail order imbalance is positively predictive of future returns, suggesting perhaps the retail traders might be informed. Our evidence, at least for Robinhood investors, goes against that narrative. So, but the takeaway here so far is that the Robinhood investors appear to be noise traders. So with that in mind, what are the effects of the Robinhood traders on market quality? And ex ante, it could go either way. Theory gives mixed predictions. On one hand, more noise traders reduces the chance that the market maker could get picked off, and that leads to lower spreads, so reduced adverse selection. On the other hand, perhaps noise traders herd or have autocorrelated trading, which leads to fluctuations in the market maker's inventory, and perhaps spreads widen as compensation for this inventory risk. So it's ultimately an empirical question how the Robinhood, the noise traders may impact financial markets. As is always the case in finance and economics, identification is challenging. Retail trading in our setting is likely to be endogenous. We have, though, what we think is a pretty neat way to address this concern. So we use Robinhood platform outages as an exogenous shock to Robinhood trading. So when the Robinhood investors aren't able to trade, what do the financial market quality statistics look like? And we do something that's like a diff and diffs type approach, where the cross-sectional difference compares market quality statistics for the stocks that Robinhood investors trade the most versus the ones that they don't trade as much. And then the time dimension compares market quality over the outage period versus the pre-outage benchmark period. And again, as a preview of our result, we find that during the outages, the stocks that are favored by Robinhood traders tend to have lower trading activity, improved liquidity, improved spreads, essentially, and reduced volatility. So,
Craig,
yep.
This is Albert Menkveld.
Okay. Hi,
Super
Albert.
interesting data. Just a quick clarification question. When you say it's exogenous, the outages, are they the result of many Robinhood users trying to get to the platform to do a trade because of market conditions?
Yeah, thanks, Albert. That's a good question. So I have here at the bottom, results are robust. So one important robustness test that we do to address that concern is we throw out the stocks that are the most newsworthy on that day. So when we do that, our results continue to obtain, which gives us some confidence that we're addressing that critique.
Does it include the outage? This was during the GameStop stuff. Does it include the one that was basically due to them having like insufficient capital to meet?
So our sample
trade
period. So I'll talk about this in a few slides. The Robinhood data, they stopped supplying this data last August. So we actually don't have the GameStop in our data.
Damn. All right. Cool. Thank you.
That's right. Yeah. Yeah. Okay. So the results are robust to several different tests, and I'll give you guys a little bit more details on that in a few slides. So then what we do is we take a stab at trying to explain the channel or the mechanism that explains this negative relation between Robinhood trading and market quality. And this is where high frequency traders come in, because of course, as you all probably know, the majority or most retail trades are mediated by HFTs who pay for order flow. So how could this flow through to lit markets? Because HFTs typically have a wholesale unit that processes the retail trades. Well, what could happen is that wholesale unit's still subject to inventory risk, and that can bleed over and impact the overall firm risk for the HFT. So as a response, the other units of the HFT, for example, the market making unit, may also alter their risk exposure and how they trade. And as it turns out, the Robinhood affiliated HFTs are some of the leading market makers in the US stock market. So they can have real impacts. And we do a few tests to explore this hypothesis. First, we have data that identifies some of the trades by Robinhood affiliated HFTs, and we find that they do in fact post improved spreads during the outages, whereas non-affiliated HFTs don't have a change in quoting behavior during outages. So this suggests that some of the market quality results that we document are in fact coming from the Robinhood affiliated HFTs. And then we explore this inventory risk channel a little bit further with a couple of more additional tests. One is we look at quote imbalances. So if there's uninformed trading pressure, which can create inventory risk, this may lead to the market makers quoting imbalances. So maybe one side is more one side of the order book is imbalanced compared to the other side. So what we find is during the outage, this imbalance unwinds, which is consistent with inventory risk unwinding for the Robinhood affiliated market makers. Another way we explore this inventory risk channel is that we document that the market quality effects that I described in the previous slide are strongest for stocks with a different proxy for inventory risk, which is autocorrelation and Robinhood order flow. So there seems to be, so our evidence is consistent with the inventory risk channel playing a role in describing the market quality effects. There is a related literature, and this literature is growing. I have several slides I still want to get to, so I don't want to spend too much time on literature, but we do think that we make an important incremental contribution to the existing studies. Okay, so
we have a question in the chat from Marius Soikan. Marius, do you want to ask your question in voice?
Sure. So it seems to me that there are two channels here. There is the retail trading per se, and there is the internalization. So when you have the liquidity result, that actually less noise trading leads to better liquidity, that comes from the internalization. So I was wondering what's sort of the main angle here. Is it the retail trading or is it the payment for order flow? Because it might have different policy implications.
Yeah, it's a good question, and it's related. So it's somewhat hard to say. I mean, but without the retail trading pressure, I presume the HFTs wouldn't behave that way. So I would say that the retail trading behavior is a key driver.
Because here in Canada, right, payment for order flow is actually legal. So that would, I don't know, if we have some sort of data like the Robinhood data or like the Boomer identification where we can sort of look at the differential impact between the different markets, and it might actually give you some ideas.
Yeah. So I guess it would just basically, it flows, like what you're asking essentially, what if it flows straight to the lit market?
Exactly. Yeah.
Okay.
Because then I would expect better liquidity if these guys are really uninformed.
Yeah. It'd be interesting to study. My prior would be you would still see some of these effects. But yeah, it would be interesting to study. Yeah.
Thanks.
Thank you. Yeah.
So Greg, I have a question too.
Okay.
This effect that you observe better liquidity at the market when the Robinhood traders are not there. It somehow signals that it's costly to trade with them. And still you have payment for order flow where the intermediaries are actually willing to pay to intermediate this flow. So there seems to be a mismatch. If it comes with costly inventory management, then why do they pay for it?
Yeah, that's a good question, Bjorn. So I'm wondering if they're sort of getting their cake and eating it too. So they get the advantages of trading with uninformed traders, and then if there's a case where there's this trading pressure, then they just to some extent pass this on in the lit market. Does that make sense?
Yeah.
Yeah.
Greg,
Yeah.
could this be the function of your sample period? Because I think you guys are looking at 2020.
Yeah.
Is that right? And that's a very unique year for retail. Could that be partly the answer to Bjorn's question?
So maybe like the world has changed. So maybe
sort
the
of like,
HFTs didn't quite get what they signed up for during 2020.
Yeah, in 2019, all of this made sense, but in 2020, the market changed, and they have to deal with it.
That's possible. That's possible. It's hard for us to completely rule that out because I mean we do have data prior to 2020, but there's not many outages during that time period. We do throw out March of 2020, which was especially extreme, and the results continue to hold. So I guess that's about the best we can do. It's also interesting, like if that really is the case, then the HFTs could respond by increasing or decreasing essentially what they pay. I don't know if they would do that in real time or not. But yeah, it's a good question. It's hard for us to say because we don't have our sample period doesn't allow us to go back prior to 2020 for the setting that we studied.
I was going to ask as a follow-up there, and maybe you don't know, but how the contracts for payment for order flow are designed. Is it a bulk of orders for a set period of time that you sign up to pay for, and how long are such periods?
Yeah, that's a good question, Bjorn. I actually don't know, so that's something that we could do a little bit of research on. To understand
interesting.
better. Yeah.
Are there any other questions now, or shall we let Greg move on? Great. I think you can continue, Greg.
Okay, cool. So what we do first is, before we get to the market quality result, let me show you a little bit of evidence on the skill of the Robinhood traders. So let me first describe our data. a little bit more. So Robinhood used to publish the number of users that hold each stock, and that number would be updated frequently throughout the day. And that allows researchers to scrape the data from the Robinhood website. And there's actually another website called RobinTrack that did that. So we obtained this ownership data from RobinTrack. Unfortunately, as I mentioned earlier, Robinhood stopped publishing this data last August. So our sample period ends in August of 2020. So for this return predictability analysis, we construct a Robinhood trading proxy that's the weekly change in ownership for each stock. In addition to that, we also have a broader measure of retail trading that we compare and contrast to the Robinhood proxy. And we borrow the Boehmer, Jones, Zhang and Zhang forthcoming Journal of Finance methodology to construct this measure. So this is going to capture retail trading from all brokers, not just Robinhood. And then what we do is we just do some Baumol-Beth regressions and see how the Robinhood trading proxy and the broader measure of retail trading relate to future returns. So we look at a few different future return windows, 1 to 3 days, 1 to 5 days, and 1 to 20 days. The first row is the key result. So that's the Robinhood trading proxy, and underneath in parentheses are T-stats. So you can see that there's no evidence that this measure is related to future returns. If anything, the point estimates for the most part are negative. So this is our evidence suggesting that the Robinhood traders appear to behave as noise traders in terms of predicting future returns. In contrast, if we look at the broader measure of retail trading, this aggregate retail OIB, we confirm that the prior findings hold in our sample period. So we continue to find, consistent with the prior research, that the broader measure of retail trading predicts future returns. So that's a little bit of evidence here, but again, the takeaway here is the Robinhood traders appear to be uninformed. So with that in mind, now that we have some evidence of noise trading behavior, let's now go and spend the rest of the paper studying market quality effects. But before I do that, I have a few slides that'll tell you a little bit about our empirical approach. So we use the Robinhood platform outages as an exogenous shock to Robinhood trading. So we collect the outage data from a website called Down Detector. So this website collects outage complaints from a variety of different websites, including Robinhood. They update these tracks every 15 minutes. And what we do to make sure that we're actually picking up a real outage, we require at least 200 complaints. And what that does is that gives us a sample of 25 unique outages with a median link time of 30 minutes. Our sample period runs from January to August 2020. The bottom half of this figure has a couple of things. The blue time series are the change in Robinhood ownership over time, and then the gray vertical bars are the platform outages. And different people can look at the figures and come to different conclusions, but we look at this and it appears, at least to us, that the outages are fairly evenly represented or fairly evenly distributed over time is our takeaway. Okay, so
Greg, there is a question.
Okay.
I think there was a hand up from Federico Nocera.
Yes, hi. I'm Federico Nocera. Hi, Eaton. Can you hear me?
Yes.
Yeah, I'm just wondering whether your previous empirical result based on the Baumol-Beth regressions can be somehow related to the fact that the high frequency traders, the dealers, can somehow expose profits from trading with these Robinhood guys. because basically they anticipate that when they buy the shares, for instance, of GameStop or Hertz, they need to sell them afterwards. So they basically, in expectation, they can charge to these Robinhood guys a higher price. So that basically, of course, they look like noisy traders, but somehow they are noise traders because of the dealer, of the high frequency traders actions. Can you somehow comment on this? Do you think that it can be this possible? Or I was clear enough in formulating my answer, my question?
Yes, are you arguing that that essentially they're being charged a higher bid-ask spread?
Yeah, exactly, because they basically, you know, the high frequency traders have somehow are interested in getting the volume, right? The payment for order flow, but they also get an informational advantage in getting this kind of order flows, right? Because they know that there are traders which are long the underlying assets. In order to profit, these traders has to sell afterwards. And basically they have to deal with them, right? So basically, these traders, these noise traders, have to buy and sell with the dealers in a very short time period, and the dealers can have an information advantage in doing that. So basically, they can charge a bit higher bid-ask price, and then they are somehow mechanically losing when they trade with the dealers.
Yeah, I don't know if we have the data.
Thank you.
Yeah, sure. I will say one thing that I think helps with this critique is I can't remember if these actual results are presented or if we just did it as robustness tests, but the returns, at least maybe even these are as a robustness, the price used is the bid-ask midpoint quote, which would help with some of that concern about getting getting picked or getting screwed basically by the spread. Yeah. Okay, so we have the outages, and then next up is how we measure stocks with high Robinhood interest. So we use the outages to see what happens when the Robinhood investors go away, but we also need a proxy that essentially forecasts which stocks the Robinhood investors would have traded if there was not an outage. And we use a few different measures to do this. Each of these are constructed over the week immediately preceding the outage. First one is a Reddit Wall Street Bets proxy. So another thing that this, of course, been in the news a lot. So Wall Street Bets is a platform, a community of retail investors, and many Robinhood investors use Wall Street Bets. And we count the number of unique posters that mention each stock on Wall Street Bets as a proxy for Robinhood interest. We also use a couple of different other measures right before the outage, the level change or the percentage change in Robinhood users. And to pick up the ones that the Robinhood investors are the most interested in, for each of these measures, we sort stocks and we keep the top quintile of stocks for each of these measures. And those are going to be the ones that we consider to be the high Robinhood interest stocks. We do the analysis for all three of these. For the interest of just keeping it fairly brief, I'll just show you guys results for the Wall Street Bets. I have a figure here, and I'll just quickly go over it. So down here at the bottom, days surrounding high WSB or Wall Street Bets mentions. So basically what we do is we sort stocks based on ones with high Wall Street Bets mentions, and then we see how the Robinhood ownership change and levels or percentage change, how does that relate to these Wall Street Bet mentions? And the first couple of panels here do a couple of things. one, it shows that the Robinhood investors do in fact respond to the Wall Street bet mentions, and two, the Robinhood ownership change or trading follows the Wall Street bets mentions by a couple of days, which gives us confidence that using the Wall Street bet mentions right before the outage is a decent proxy for what would have been traded during the outage. Okay, so I'm going to move on from here so I don't run out of time at the end, hopefully. So here's our main model that we're going to estimate. It's sort of like a difference in difference type model. The Y variable represents the outcome variables that we're interested in, such as volatility or liquidity. The RH is a dummy for Robinhood stocks based on the high Wall Street bet mention activity. The outage is a dummy for the outage. And then of course, the key term, like a diff and diff model, is this interaction. That's going to show us what happens to the Y variable during the outage for the stocks that Robinhood investors are the most interested in. The subscript T are 5-minute intervals, so we measure our variables in 5-minute windows. And then our sample is the actual outage time period, and then the same time of day over each of the previous 5 days, which essentially serves as our benchmark period. We have day and firm fixed effects, and we do analysis for the actual outage as well as a pseudo outage that begins 1 hour after the outage ends. Okay, so let's now go through some results. First is how our volume or trading activity, how is that impacted by the Robinhood outages? So the key row to focus in here again is this interaction term between the high Robinhood stocks dummy and the outage dummy. And the first 3 columns represent the actual outage. The next 3 columns represent the pseudo outage. And what we see is that during the outage, so when Robinhood investors go away, the volume significantly drops. This volume measures are logs. So for example, an 8.4% drop in volume. In contrast, for the pseudo outages, we don't see any action over there. So nothing happens once the outage is over. So basically, when the Robinhood investors go away, the trading activity significantly drops. And this helps us build the case that the Robinhood investors can have an important influence on financial markets. So next we turn to the measures of market quality. Maybe I'll make this a little bit bigger so you guys can see it. So this is one of the main results in our paper. So again, the key row here is the first row, the interaction term. And we have some various measures of liquidity during the outage and also during the pseudo outage. And we see that so these are of course measures of illiquidity, so inverse to liquidity. So when these measures go down, that actually means liquidity improves. So, and we see, that's what we see here. During the outage for the high Robinhood stocks, the liquidity significantly improves. These are in basis points. So an effective spread drops, for example, by a little bit more than 6 basis points. Again, we don't see any activity during the non-pseudo period or during the pseudo period. Yeah, Andre.
Yeah.
Greg, just a quick question. You guys are finding that the price impact declines. That to me always has more to do with liquidity demanders rather than suppliers. Do you have an explanation for that?
Yeah, that's a great question, Andre. And that's one that I've been thinking about recently. I mean, yeah, is there an adverse selection part? There could be. Something that we've been thinking about too is, you know, this price impact measure, of course, is an imperfect measure of trying to pick up information. It's over 5-minute windows. If trade pressure is going on for periods longer than that, then we may actually just be picking up the trading pressure with the price impact. But yeah, it's something that we should maybe at least spend a little bit more time thinking about and writing about.
Can I ask one more quick question?
Yeah.
There was a table before this one. There was a very interesting variable there, aggregate retail volume. What's that? Is that using the Bomer-Jones-Zhang-Zhang? Yeah,
that's the Bomer-Jones-Zhang-Zhang measure. And you might be asking, why doesn't that significantly drop? Yeah, that's another thing that's we've spent some time thinking about. So one possible explanation is that some of these Robinhood investors likely also have accounts at the other retail brokers, so maybe they're hopping over to the other ones. Of course, that could only happen to some extent. Otherwise, if that happens too much, then we wouldn't have any results. Something else that I've, and this is just sort of just a conjecture, and I don't know if we would have the data to look at it, but I'm wondering how much of the Robinhood trades are being picked up by that measure, because that measure was, of course, for off-exchange trades that receive typically a small price improvement. So perhaps Robinhood trades are more likely to occur on exchange if the wholesale inventory books get overrun. Maybe they're more likely to get passed on. Maybe Robinhood, the HFTs of Robinhood are less likely to give price improvements than compared to the other brokers. I don't know. Unfortunately, I don't know if we have the data to explore those ideas. But yeah, that's sort of what I've been thinking about. Thanks, Andre.
So Greg, I don't want to mess up your time completely, but I wanted to ask about the level of these results on the liquidity results. You had minus 2.9 basis points in quoted spread and minus 6 basis points in effective spread. That sounds like huge effects, but that of course depends on what your average is. Are these very small stocks?
Yeah, so so these are basis points. Let me see. I think the average in our sample is something like 60 or 70 basis points, something like that.
For the quoted spread?
Yeah, well, for the effective spread, let me see. I can maybe, we have it in the summary stats. Quoted spread. Okay, so quoted spread for the high Wall Street bet stocks is 20 basis points for the quarter 5 or quintile 5. Effective spreads is 127 basis points.
So if it's 20 basis points, it sounds, for quoted spread, it sounds like fairly small stocks. 127 basis points in effective spread in 2020 sounds incredibly high.
Yeah, the firm size, they actually tend to be bigger stocks. So the firm size here, this is the Q1 through Q4, this is and then Q5 is the high Robinhood stocks.
Okay.
These are percentage spreads. Yeah. Does that? Yeah.
Well, probably something to look into, but maybe not in real time.
Okay. Okay, thanks, Martin. All right, but I'm gonna keep going. All right. So next up are volatility drops, or volatility effects during the outages. So return volatility significantly drops. So again, the first row here, the interaction term for the outages versus the pseudo period, the volatility significantly drops during the outage for the high Robinhood stocks. So taken as a whole, the evidence suggests that when the Robinhood investors go away, market quality significantly improves. We do a number of robustness tests. I've already actually mentioned, as we've gone, a couple of the key ones, throwing out the most newsworthy stocks, second bullet point, throwing out March of 2020, which is a a special time period. We do some other robustness tests and the results continue to hold, but I just have a few more minutes left, so I want to move on. I do want to show you this figure though, because I think this is a nice visual illustration that's consistent with the regression results. So this shows the key Y variables that we just looked at, volume and liquidity measures and volatility. The red line are the high Robinhood interest stocks. The blue line are the other stocks that the Robinhood investors don't trade as much. And we look at before, during, and after the outage period. The gray bar represents the outage time period. And there's a few things to note here. One, prior to the outage, you see something that looks pretty close to parallel trends. The high Robinhood stocks and the low Robinhood stocks tend to have a similar behavior in terms of these key Y variables. But then during the outage, that's where you see all the action, which is consistent with our regression results, which you see a big drop in volume in the illiquidity measures and volatility, but only for the high Robinhood stocks. There's not much action for the low Robinhood stocks. And then after the outage, once the Robinhood investors come back, then you see that these measures all respond pretty quickly. Okay, but now let's turn to the exploring what may explain this market quality result that we've documented. And we're gonna, again, focus on high frequency traders mediating the Robinhood trades. We start by doing a few different things. First, we look at how HFT activity in general is impacted by the outages, and we use a few different measures that are commonly used in the literature for HFT trading proxy. And then we focus in on the Robinhood affiliated HFTs, and then we specifically look at the quotes for these Robinhood HFT market making trades and see how they're impacted by the outages. But first, let me show you just the general HFT activity effects. Again, the first row is the one to focus on. The first three columns are the actual outage. The last three are the pseudo outage. And we see that during the outage, when Robinhood investors go away, HFT activity in general significantly drops. What about for the HFTs that are specifically affiliated with Robinhood? And what we look at here are the bid-ask spreads for the affiliated HFT and the market making unit specifically for the affiliated HFT. And we have the Robinhood market makers and then the other market makers during the outage and then not during the outage. And you see only for the Robinhood affiliated market makers, we see a significant drop in the spreads. We don't see a drop in the spreads for the other market makers and then nothing during the pseudo outage. So it appears this is evidence suggesting that at least to some extent, the market quality effects that we documented a few slides ago appear to be coming from the Robinhood affiliated HFTs. Okay, and then exploring a little bit further. So what might explain why the HFTs alter their quoting behavior? We focus on the inventory risk channel. And we do that a couple of different ways. First is we explore imbalances in trades and quotes. And the idea being here that imbalances may be a sign of inventory risk from uninformed trading pressure. And when the outages occur, do these imbalances unwind, which would be consistent with the inventory risk unwinding. And we look at a few different measures of imbalance. We look at trade imbalance, so just the difference between buy and sell volume. And then we also look at quoted, so that the depth imbalance in general, and then also depth imbalance for the Robinhood affiliated HFTs. So I'll show you some results on that. And then we hone in and do another test for inventory risk. And we look at the autocorrelation in trading by the Robinhood investor. Specifically, we create a autocorrelation measure. We sort stocks into quintiles based on this measure, and we keep the stocks with the highest quintile of autocorrelation, and we use it as a proxy for high inventory risk. And we see how that interacts with the high Robinhood stock and then the outage dummy. I'll show you some results on that too. But first, let me show you the imbalance results. So first column is the trade imbalance. Second column is just the depth weighted imbalance in general, so not for Robinhood specific market makers. The third column is for the Robinhood affiliated market makers. What's the depth imbalance doing during the outage? Then for other market makers, and then the pseudo period. And again, looking at this first row, we see that the imbalance measures significantly fall during the outage for the high Robinhood stocks. And if you look at the Robinhood affiliated imbalance, you see it significantly drops, and we don't see anything for the other market makers. So imbalance tends to unwind during the outages, which is consistent with inventory risk unwinding. And then what we do is a final test here I'm going to show you, and then I'll shut up, is we take the model that I've been working on for the last several sets of results, and we add a triple interaction term. So it's similar to before, but so we still have the Robinhood, high Robinhood stock dummy, the outage dummy, and then we add this inventory risk, which again is the stocks in the highest quintile of autocorrelated trades. And we see what happens to our various measures of market quality and imbalance during or for this term. And we see a significant improvement in liquidity, and the imbalances also significantly drop. So the effects are the strongest for the stocks that had the highest inventory risk according to this autocorrelation trade proxy. So again, consistent with the inventory risk story being a key driver, explaining the market quality effects that we document. But that is it. So I am out of time, so I'll just leave this conclusion slide here. So thanks again, everybody who's taken time out of your busy day to spend some time listening to me present our research, and I'm happy to talk about any more questions or comments that you guys may have.
Thanks a lot, Greg. Very nice presentation. Greg has promised to stay on as long as we have questions, so keep them coming. You can use the raise hand function if you find it in Zoom, and I'll try to keep the time priorities. Albert Menkveld is first up.
Yeah, nice talk, Greg. Interesting set of empirical findings. I wonder what to make out of this. So it seems like you're suggesting you have a study on what the presence of Robinhood trading means, but I'm not sure if the data allows you to make those statements in the following sense. If an outage lasts 15 minutes or say half an hour, isn't it that we're looking at what will happen if it's sort of delayed response to Robinhood activity, because these guys trade over a set of days. A 15-minute break might just be a pause of the market in some sense, and then we'll resume and everything changes. So it's not that we have an experiment here where we would remove Robinhood traders from the market entirely and do away with payment for the flow. Is that a sensible concern or no? I'm trying to get my head around what we learn now.
Yeah, I think that's a reasonable concern. Yeah, like on one hand, we're doing the best we can, as you mentioned. On the other hand, though, if the Robinhood investors do go away, the results, what we find could look like this. I don't know if just because it's a short window doesn't mean it's wrong, I guess.
No, that's right. Do you have variation of the length of the outage? So if what I'm saying matters at all, then you should see differences when you have an outage that lasts for a full day or maybe even 2 days. then it's closer to what I say. Then the reason for trading might have gone away, and that might be in some sense a cleaner identification strategy. If it's just a few minutes, then I wonder if it's just delayed response, but the market's still going to respond. Anyway, that's what I wanted to share. I'm trying to think along with it.
Okay,
Thanks.
thank you, Albert.
Nice paper.
Thank you. We do have variation in the outage length. So on average, they're shorter, but some are as long as a day. So we could explore that a little bit. Yeah.
Thanks.
Yeah. Yeah, Andre?
Greg, have you thought about doing an event study looking at what happens once the outage is over? Do spreads go up right away, or do they take a minute, or by a minute, I mean, do they take a while to sort of ramp up back to where they were before the outage?
Yeah,
oh,
so
there
I think
it is.
that, yeah, this figure helps with that. And they come back pretty quickly.
Okay, because I was thinking, is it an inventory story or is it an inventory risk story? Because as soon as you turn Robinhood back on, your inventory risk goes back up right away, but your inventory actually takes a while to catch up with that level you don't want. So it looks here like it's actually an inventory story more so than the risk.
Okay, yeah, okay.
And I have, well, I'll let Amy ask her question, and if we have time, I'll have another.
I had a follow-up on mechanism. And so one mechanism I thought of is that if you look at the 606 reports, then Robinhood is actually different than a lot of the other retail brokers in that they get a payment for order flow on a percentage of the spread basis. So based on that, when Robinhood is trading, the market makers have an incentive to have wider spreads. So it could be that Robinhood being down is an input into the market making algorithms used by the market makers that are paying for Robinhood orders. And I know that's a fairly skeptical view of the world, but I was wondering what your thoughts are on that mechanism.
Yeah, that's a good point. So that was Amy Edwards. Yeah, that was a
Yes.
good point. Yeah, that's a good point. I'm curious how we could address that with our data if we could. Yeah, but yeah, that's something we can explore a little bit further. Thanks, Amy.
So we have Andre again, and we have then Andreas.
Okay, Andre gave up, so I'm going to go.
Yeah.
So can I ask, so one of the things that I would like to think about a little bit is the limit order side. So when you, I would imagine that there's also Robinhood traders that don't just use market orders which go to market makers, but actually post limit orders, which most likely will go to the venues directly, to the lit venues. And so first, what is not clear to me is what happens with limit orders when there's an outage. There's something called cancel, cancel when you have a connection issue, or if they just stay in the book. And then there's the question of whether or not competition from limit orders could drive, the ability or the willingness maybe of professional traders to post more aggressively. So I'm not sure if I'm making this clear, but if you as a market maker don't have to compete with limit orders from the retail traders, it's easier for you maybe to provide liquidity to the market as a whole.
Yeah, thanks, Andreas. So one thing that's a little bit funny about Robinhood is our understanding is that they sell both the market orders and the limit orders to the HFTs. So and then the HFTs take it from there. So we should have all of those in our analysis, both the limit orders and the market orders. And then from there, I think it's hard for us to study to break them up because that's just opaque. But yeah, but thank you.
Interesting.
Yeah.
There's a question from Liang Yang.
Hi. I have two questions. The first question is about the kind of implications for node traders. So the retail investors, it seems those people are node traders, and so having Robinhood giving them zero commission fee, I'm not sure whether it's really good or bad for them. So like they can trade more aggressively, more excessively, or they get worse bid-ask spread from through that pay for order flow kind of practice. And so kind of like the very fair consequences of this zero commission fee from Robinhood. This is the first question, kind of conceptual level. The second question is related to my paper with Hao Xiang. So if Robinhood is kind of with those HFTs doing this kind of pay for order flow, so there are two potential channels through which this practice affects the bid-ask spread. So one is those HFTs work as market makers. So this might kind of reduce the bid-ask spread. Secondly, they might work as backgrounders. So they can learn information through this order flow. Basically, they will trade together with the other liquidity demanders. So that can make a bid-ask spread worse. So I'm kind of to whether you have some idea to differentiate these two possibilities. This is
Cool.
Thank you.
Yeah, thank you. So the first one, if I understand, is sort of like, sorry, zero commission trades actually a good thing for retail investors or not? And that's hard to say. On one hand, you don't have the fixed fee anymore, and then if nothing else changes, then that's good, of course. But does that come with worse market execution quality, which I think there's some evidence that does happen to some extent. And then also it's what's good for your own good. If you trade too much, is that actually bad? And the zero commissions actually incorporate that. So it's a complicated thing, and we've been thinking about it a lot, and it's hard to say, to be honest, what, you know, if it's a good or bad thing. Yeah, I guess it sort of depends on the person and what they do with it in terms of the value. But then in terms of the market quality, I think we maybe need some more evidence on that too. Your second question, could you repeat that again, Ian?
Yeah, so that's basically pay for order flow. So it depends on whether the HFTs are liquidity providers or liquidity demanders. If they kind of work as market makers, so that's a liquidity supplier. And if they extract information from pay for order flow, so that's more like a liquidity demander. So these two directions, these two rules can make the prediction of this. And I'm not sure whether you can have a way to tease out the difference.
Yeah, I don't think we do. It can, unfortunately, that we were barely able to get some trades that identify the identity of the market makers, and that allows us to do some of the stuff we did with the Robinhood affiliated HFT results. But those are just for the market making trades, so more the liquidity supplying side. We don't have data, unfortunately, on what HFTs do on the demand side. I know there's the NASDAQ data from a few years ago. I don't know if we could get something like that during our sample period, unfortunately. But it is an interesting question. Unfortunately, we're sort of limited to what we can do.
So we have reached the full hour. Some of you may need to check out, but we're planning to go on for yet a while. So thanks for everyone who attended today. I'll also announce that the next one in 2 weeks will be by Carol Comerton-Ford. We have a couple of questions, or at least one. John Ritter.
Hi, I was wondering, did you actually look at the percentage of time that the Robinhood market makers are at the MBBO compared to the non-Robinhood market makers? And did this kind of vary between your high Robinhood participation stocks versus ones that they didn't participate in as much?
That's a good question. We did not look, as far as I know, at how often the Robinhood affiliate versus the non are at the oh, did we, Brian?
We did, and it's neither of them are right at the MBBO. That they choose to mark themselves. So the data that we see is only when they've chosen to mark themselves. But when they do identify, it's pretty even as far as how aggressive they are. So they're still close to the MBBO, and between Robinhood and non-Robinhood, it's pretty close to even as far as their competitiveness. If that was, I don't know if that was your whole question, if there was more to it.
No, that was it for now. Thanks.
Okay.
Okay, so there are a couple of questions in the chat. Simon Jurkatis, do you want to ask your question live?
Yeah, sure. I just couldn't find the raise hand button. So I was just wondering whether it would be worthwhile for HFTs to increase the target inventory if it's an inventory story. So I was just wondering whether they maybe not have yet realized that there's increased retail activity that maybe isn't as risky as they might perceive, because they think there's more informed trading in the order flow than there actually is. So that the result in that the spread decreases during these outages is just because it's a maybe calmer market with less volatile order flow. I don't know if that makes sense.
So you're sort of wondering if the HFTs are overreacting to the inventory, like the trade pressure, the inventory imbalances.
Yeah, exactly. Outside of those outages, and that in fact they should sort of increase the target inventory a little bit outside those outages, and then you would see that spreads would become smaller.
Yeah, it's hard to say. To some extent, I mean, there might be constrained on how much inventory they have on their books and how much they want to have on their books, even if it is uninformed. If it's on their books longer than they would like and creates their exposure, then that's something that they may want to avoid.
Yeah, no, but so have you spoken to practitioners, to HFTs, and asked them about, how much are you aware of this increased retail activity, and how do you like it?
We did talk to one of them. We talked to Virtu for a little bit. Brian, do you know? Did they say anything about that?
I missed the last part of that.
Basically, are the HFTs aware of the inventory, and are they trying to offload it as much? So
not specifically to Robinhood outages, but in general, yes, they are constantly monitoring their positions and whether they have the capacity to take on inventory. And from these conversations, it seemed that the outage would happen so quickly, being 15 minutes or 30 minutes, like a human might not see the outage happen, but the algorithms would check with the central risk desk and see if they have capacity to take on the inventory. So they are constantly monitoring whether they can, whether they have the tolerance to take the position or not.
There's another question in the chat from Renee Wells. Renee, do you want to ask this question live?
Okay, sorry. To go back to Bjorn's observation, the HFT, they are paying for that order flow. So you have to assume, I would say, that there's a logical explanation why they are doing that. And intuitively, they're paying for the order flow because from their perspective as market maker, this is quote unquote better liquidity. And they might intermediate also between that market and I would say some other markets where there is more adverse selection in reality. So to a certain extent, I would say if you look at kind of the quote unquote sink from the perspective of, I would say, the overall cost of liquidity, meaning the payment for order flow, then logically, I would say I should assume that if you remove that, the whole market is going to benefit. So intuitively, I would say I see the logic of your empirical results, but I'm not sure that this is true a reduction of inventory risk from the market maker perspective. Okay, it looks like you're focusing a lot on that channel. I'm not sure that this is the key channel, and I'm not sure I would say that channel intuitively makes sense as soon as on an ongoing basis the market makers are willing to pay for that liquidity. Please note also that Robinhood, in their business model, they have a huge incentive for the traders, their customers, to be uninformed. Because if they were informed, okay, of course, I would say the whole business model of Robinhood would not work. So this goes also in line with the previous comment that this whole Robinhood, I would say, free trading is kind of distinct in its business dynamics from, I would say, the traditional venue. Thank you.
Yeah. Cool. Thank you. So what do you think, I guess to bring it back to you, what do you think would explain our results that the market quality does improve during the outages if it's not the inventory story, at least partially playing a role?
Okay, it's like a ping pong game, eh? It's if you have segmented markets and all of a sudden for a short period of time, those markets are no longer segmented, okay? You might have several channels, okay, that I would say change all of a sudden, okay? But for sure, okay, if the HFT, they are, I would say, not only making money from trading with the Robinhood traders, but intermediating between different, I would say, kind of liquidities because the market are segmented. Because as soon as you allow order flow to be bought, okay, by definition, you're not creating maybe a segmented market on the pricing because the regulation, I would say, disallow that. But from a liquidity perspective, it looks to me like you are segmenting the markets. And maybe the HFT, I would say they are, I would say, intermediating between, I would say, the segmented market they have created by buying the order flow and the free-for-all in the rest of the market.
Okay, thank you.
So there's time for more questions, if there are any. I have another question, Greg,
okay,
about the Robinhood affiliated HFTs. It's very exciting to see that you have the individual spreads from this. I wonder if you can do more with that. And related to that thought, I was wondering if you know how it works when there are several HFTs that are buying this order flow from Robinhood. How is it segmented across the HFTs? I was thinking that maybe there is segmentation across stocks, that you can buy the privilege of trading with Robinhood traders in specific stocks. If that is the case, you could maybe use that for further identification of your inventory story. Do you know how it's segmented?
Yeah, those are good comments. Thank you, Jordan. we could segment by, because we do have the identity, so we could segment by the actual HFT. My understanding is that the payment for the actual fee or rebate is the same across the different HFTs for Robinhood. I'd have to double check that, but that's my understanding. So if that's the case, I'm curious if you would see different effects. I suppose there might be something idiosyncratic to the HFT that could also play a role. So yeah, it's something we could look at.
Yeah, I was wondering if, for example, Virtue can buy the order flow in the GameStop stock, and then Citadel buying the order flow from another stock. Then if you can see both the trades and quotes of Virtue, then you could see how they adjust their quotes in response to inventory at a very detailed level.
Okay. Yeah, I think we can do that, Brian, right? Don't we both have
the HFT can't pick and choose which stocks they want. They have to take it all. And then how the percent that they're allotted is based on how good they are at improving the customer's prices.
I see.
But they only make a market in some of the stocks, right?
So as a market maker on the exchange, they can choose. But as far as what they purchase from the retail broker, they have to take it all.
Yeah.
But maybe they can improve. Maybe they give better price improvements on some stocks than others. Maybe. There's another hand up from Andre.
Sorry for so many questions. I wasn't going to ask this one because I was pretty sure that you guys probably don't know, but then Brian said that he talked to Virtue, so I'm going to try this one. Do you guys know, or maybe you have seen the contracts, what happens if Citadel or Virtue or an HFT firm has technical difficulties? In other words, Robinhood has nowhere to send the orders. What happens then?
I don't know, Brian. Do you know?
So I don't. Yeah, there was no indication that ever happened. That they relayed to us.
I'm subtly trying to get to my slightly bigger point that what if, is there something in those contracts that says that Citadel can message Robinhood or whatever, call them and say, we're having inventory issues. Can you slow down your flow?
So if that was to happen, so I don't know the exact percent, but it'd be from the conversation, it could be 10% to 40% maybe, that if the wholesaler does not want to take on the inventory and they don't have an offsetting order to counteract it, they just can send it straight to the exchange. They don't want to do that because one, they had to give price improvement to the retail order. And then when they go to the exchange, they have to pay the taker fee to the exchange. They don't prefer to do that, but if they do not want to take they don't have inventory capacity, there's no offsetting order, they can still send it to the exchange.
Can Robinhood go to the exchange directly now? I thought, I haven't been following their legal status. Are they actually a broker now?
I didn't think they were.
Okay.
Right, Brian? I'm not. I had to verify that. I know they weren't at one point. Maybe that's changed, but I thought that they sold. I thought that they sold everything.
That was my impression. But not so much that I'm.
Because if they could go to the market, then that brings up the earlier point that Andreas raised. Like, because that's something that was interesting with the limit orders. Like, why would they not just sell those? The deal they get from the HFTs must be so good. Like, why would they not get the rebate for the limit orders? But I'm pretty sure they sell everything to the HFTs, but we can double check.
So we have another question from Amy.
Yeah, sorry, this is just an answer. Robinhood is not a member of an exchange. So for its orders to get to the exchange, they have to send it through somebody who's a member of an exchange.
Thank you.
Great. Are there any other questions before we conclude? Andre? Okay, there seems like there are no more questions. Thanks a lot, Greg, for a very interesting paper. Thanks to everyone for coming, and hopefully see you next time.
Cool. Thanks, guys.
Thanks, Greg.
Thanks, Cameron.